Palantir billionaire Peter Thiel has once again captured the attention of investors after making a dramatic portfolio shift that signals a meaningful change in outlook for the technology sector. Thiel recently eliminated his entire position in Nvidia and redirected that capital into another widely admired technology stock, even as legendary investor Warren Buffett had been trimming his exposure to the same company prior to retiring from active portfolio management. This move has sparked widespread discussion because it reflects not only a change in individual holdings, but also a broader reassessment of risk, momentum, and long-term stability in today's market. Peter Thiel is widely recognized as one of the most influential figures to emerge from Silicon Valley. His entrepreneurial journey began with the founding of PayPal, a financial technology company he co-created alongside a then relatively unknown Elon Musk. That early success generated enormous personal wealth and established Thiel as a central figure in the technology startup ecosystem. However, his career did not stop at entrepreneurship. Instead, it evolved into one of strategic investing and capital allocation at the highest level. After monetizing his stake in PayPal, Thiel transitioned into the role of a professional investor. Over time, he developed a reputation for identifying transformative companies before they became household names. One of his most notable achievements was becoming the first outside investor in Facebook, which later rebranded as Meta Platforms. He also co-founded Palantir Technologies, a company specializing in large-scale data analytics that now plays a significant role in government and commercial intelligence applications. These early bets helped define Thiel's legacy as an investor with a keen eye for long-term technological disruption. In the present day, Thiel oversees capital through his hedge fund, Thiel Macro. According to the fund's most recent Form 13F filing, Thiel completely exited his position in Nvidia during the third quarter. In total, the fund sold 537,742 shares, fully closing out its exposure to one of the most influential companies in the artificial intelligence hardware space. Given Nvidia's prominence in powering data centers and advanced computing systems, the decision immediately raised eyebrows. What makes this development even more compelling is the destination of that capital. Rather than doubling down on artificial intelligence infrastructure, Thiel chose to build a position in Apple. This decision stands in contrast to Warren Buffett's recent actions, as Buffett had been gradually reducing his Apple holdings before stepping back from day-to-day investing. Seeing two high-profile investors move in different directions with the same stock underscores how varied perspectives can be, even among the most experienced market participants. To understand Thiel's thinking, it is helpful to examine Nvidia's extraordinary rise over the past several years. When OpenAI commercially launched ChatGPT on November 30th, 2022, Nvidia's market capitalization was approximately $345 billion. At that time, the company was already respected, but its valuation had not yet reached today's historic levels. Fast forward to January 7th, and Nvidia's market value has ballooned to roughly $4.6 trillion, making it the most valuable company in the world. Despite this staggering growth, signs of fatigue have begun to appear. Nvidia continues to post record-breaking revenue and earnings, but investor behavior suggests growing caution. Since the company reported earnings for its fiscal third quarter on November 19th, 2025, the stock has advanced by only 1.7%. For a company that had delivered explosive gains for 3 consecutive years, that modest increase stands out as a potential signal that momentum is slowing. A major factor behind this caution is intensifying competition. Other graphics processing unit designers, including advanced micro devices, are aggressively expanding their offerings. At the same time, custom application-specific integrated circuit developers such as Broadcom are gaining traction by designing specialized chips for large clients. While Nvidia still dominates the artificial intelligence accelerator market, the presence of credible alternatives introduces uncertainty about how long that dominance can be maintained. Nvidia does have opportunities beyond artificial intelligence accelerators and data centers, ranging from automotive applications to edge computing. However, the timeline for these opportunities to materially impact revenue remains unclear. As a result, investors may be questioning whether the company's current valuation already reflects much of its future potential. This environment helps explain why investors like Thiel may be preparing for a near-term deceleration in Nvidia's stock performance. Rather than continuing to ride a high-momentum trade, reallocating capital into a more predictable and resilient business can appear prudent, particularly when managing a large and diversified portfolio. From this perspective, Apple offers a very different risk profile. At first glance, Apple may not seem like the most exciting artificial intelligence story among mega-cap technology companies. Compared to peers that frequently headline breakthroughs in generative artificial intelligence, Apple's progress appears understated. However, that apparent weakness may actually be one of its strengths. Apple does not need to introduce a revolutionary new device to benefit from advances in artificial intelligence. Apple's greatest advantage lies in its massive installed base, which exceeds 2 billion active devices worldwide. As artificial intelligence capabilities become increasingly embedded into consumer technology, Apple can integrate these features directly into its existing ecosystem. This integration can enhance user experience across iPhones, iPads, Macs, and wearables, while also driving higher margin services revenue through platforms such as the App Store. Unlike Nvidia, whose share price often fluctuates with every artificial intelligence headline, Apple's performance is less reactive to short-term news. Nvidia's health is typically evaluated on a quarterly basis when earnings are released, and even strong results can be overshadowed by concerns about future growth. This dynamic has led many investors to view Nvidia as a higher beta stock, meaning its price tends to be more volatile relative to the broader market. Apple, by contrast, has experienced slower growth over the past couple of years, and its artificial intelligence strategy has been described as ambiguous. Yet, the company remains one of the most dependable blue-chip names in the technology sector. Stability, while less glamorous, often becomes more attractive during periods of heightened market uncertainty. Even with modest top-line growth, Apple continues to generate enormous and highly predictable cash flow. This consistency allows the company to return capital to shareholders while maintaining financial flexibility. For investors seeking smoother long-term returns, Apple's business model can be appealing when compared to a momentum-driven stock like Nvidia. Valuation further highlights the trade-off between these two companies. Nvidia currently trades at a forward price-to-earnings multiple of approximately 24. Apple, despite its slower growth, commands a higher premium with a forward price-to-earnings ratio near 32. On a purely numerical basis, Nvidia appears cheaper, especially given its faster revenue and earnings expansion. However, valuation alone does not determine investment quality. Market cycles, sentiment, and risk tolerance all play critical roles. A stock that appears inexpensive can still underperform if expectations reset or growth slows. Thiel's portfolio adjustment suggests he may be anticipating a broader correction in high-growth and momentum-oriented stocks. Historically, when volatile positions experience sell-offs, capital often flows into companies with durable demand and resilient business models. Apple fits this description well. While its stock may not offer explosive upside in the short term, it provides a sense of reliability that can be valuable for long-term investors navigating uncertain economic conditions. In that light, Apple may not be a bargain, but it could represent a comparatively safe allocation for those focused on preserving capital and achieving steady returns over time. Thiel's move serves as a reminder that even the most celebrated growth stories can face periods of consolidation, and sometimes the smartest strategy is not chasing what is hottest, but owning what is most durable. For more stock news updates, remember to press the like button and subscribe. With that being said, I will see you in the next video.